Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. After an incredible run, gold and silver just suffered their worst day in over 40 years. Gold fell 11%, silver dropped 30%. So what caused the crash? A new Fed chair, margin calls, forced liquidations?
I want to know if Bullion's bull run is over. And in today's dumb question of the week, why do we spend billions digging gold out of a hole just to put it back in a different hole? All right, let's get into it. So in recent months, Roman, in passing, we've talked about gold and silver as well, and the incredible bull run it's been on. 2025 was the best year since the 1980s for precious metals. And every time we talk about it, you point to your valuation models and say, this doesn't quite look right. And reading between the lines, you've been half expecting a crash for a while. But was the speed of the crash surprising for you?
I think it was, and I think the reason why I expected it was because I've looked at the history of silver and gold a lot over the years. And it is this hugely spiky price profile that you see. You see these periods when it just goes astronomically high, and then it has a huge correction. And that's one of the reasons why I don't like gold as a hedge, because I think people see it as some kind of speculative asset. And I think the psychology of gold's really important, because if you see it that way, as something which is like a kind of meme coin, then you will get burnt. You'll probably get drawn into the rally just before the bust, and you'll probably get wiped out by it. Whereas if you just steadily invest in it and see it as a hedge, as part of your normal portfolio, then I think that's a much more healthy approach to it, and you're much less likely to get burnt. I know that sounds weird, that the psychological approach affects how it exists in your portfolio, but I think that's true. I think it affects how you buy it, how much you buy it, when you buy it, and of course when you sell it.
But presumably we couldn't have had such a crazy run-up without speculators coming into the party.
I think that's true. And I think if you do look at these fair price models, and of course they're not perfect, they're awful, but they do a pretty good job of explaining price moves. It's still the case, as we make this podcast, that gold is overvalued by about a third and silver is still at twice its fair price. So I think it's taken some of the fluff out of the market, this big correction we've had, but it's still the case that going into this year, we were overvalued for those two assets.
What makes you say that? What is it in the model which is saying, hang on, this has got ahead of itself? What are you comparing the price for precious metal to? It doesn't have cash flows.
No, so for both of these models, it's a bit of a fudge. What you do is you say, well, any commodity is going to be linked to the overall prices of goods and stuff. So you link it to CPI, the level of CPI.
US CPI, I assume?
Yeah, I've used US CPI for this. And I've used US real interest rates because it's a wasting asset. It doesn't do well when rates are high. And unsurprisingly, the coefficient's negative for that aspect of the model. And then the third component is the strength of the dollar because it's priced in dollars. So strong dollar, bad for gold, bad for silver. So that's another negative coefficient. So positive coefficient for inflation and negative for the other two. Different coefficients for the two models because it's different metals. And it does a pretty good job of explaining the long-term moves.
Well, hang on, because a lot of those things you've said kind of explain why 2025 was so good for precious metals, right? We had inflation, which was above target, metals like that, you said. We had interest rates falling, and we had an unprecedented weakening of the dollar. It dropped about 10% in value across the year. So shouldn't there have been a rally in metals given all that?
Yes, there should. And the model actually shows that. It shows a rally in the fair price, but nothing like what we saw over the course of the period since about summertime, maybe October of 2025 onwards. So I think a large proportion of this has been driven by a narrative. Of course, there was central bank buying, and that certainly affected the price. People say that the dollar has been weaponized, and countries which are not necessarily friendly to the US have been buying gold. They don't want to have reserves stored in a currency which may actually turn against them.
Yeah, we've had 3 consecutive years where central banks around the world have bought more than 1,000 tons of gold. That's never happened before.
Then the momentum, I think, drove retail investor buying. And we've seen huge amounts of ETF buying of silver and gold. And I think that's pretty much a FOMO rally where people see the price going up, they buy into the rally, and then we get this behavior where if there's a dip, people buy the dip, and it just seems like it's going to go on forever.
Interestingly, a lot of that ETF buying has been in Asia, and particularly China. I think Chinese regulators have tried to clamp down on how much money's been going into gold funds.
Gold and silver now, of course. And for silver, the rally's been even more extreme. And the overvaluation was more extreme because of supply and demand imbalances being bigger. And of course, for silver, you've got the increased demand from things like solar panel building. And of course, China's been building a lot of solar panels.
And the table had been laid for a massive crash because there'd been such a run-up in prices, right? Before Friday's fall, gold was up more than 60% over the last year. Silver was up, I think, almost 150% in its strongest year since the late 70s. Whenever you see a massive run-up like that, in pretty much any asset class, is it not just asking for a pullback?
Yeah, it was looking very similar to the 2 huge rallies and crashes which we've got in the dataset going back to the 1960s. The first one was infamous. It was the Hunt brothers who cornered the market and essentially bought up a lot of the supply of silver.
That was in the early 1980s, wasn't it?
Yeah, so the price went vertical around January of 1980, and then it crashed over the next couple of months. The intraday moves actually matched what we saw recently. And then silver was in the doldrums for a decade or longer, a couple of decades after that. And then we got another big run up in the early noughties. It peaked in April of 2011. And guess what happened next? Yes, we got another crash. So those were the 2 big peaks. And this rally looked very similar to that if you compare it with a fair price model.
But a 30% fall in a day for silver. That just feels crazy, doesn't it? How can the market change its mind by such a degree in like 24 hours? How is it worth 30% less than it was the day before?
I think it wasn't worth that much the day before either.
Right.
I think
It's a leading question, I have to say.
But it was funny because I remember we talked about this previously and I said, look, I should put on a 3 times long gold, 3 times short silver trade because of that compression. Because if precious metals move up or down as a whole, that position wouldn't be affected. It's only if there's a compression between the price of gold and silver. And because silver is more extreme than gold, as the 2 fell together, then you get a payoff due to that compression.
I saw that the gold to silver ratio had actually fallen to a 15-year low before this move, the lowest since 2011. And that's just because silver rallied much stronger than gold, even though gold had an incredible year.
Yeah, so that position would have just been assuming that that ratio would have actually blown out again. But look, I didn't do it. And I'm kind of glad I didn't do it because it really doesn't suit my temperament. I'd have been quite nervous about it. And of course, it would have been in my fund portfolio and it wouldn't have been fun. So kind of glad I didn't do it.
It's interesting you bring up levered funds because I think a lot of retail investors have gone into this whole escapade with leverage. And if you held a 3 times levered long silver fund going into Friday, what would have happened? The fall was pretty much big enough to destroy the entire value of the fund, wasn't it?
Yeah, and I think the 3 times levered funds didn't want to repeat what happened with nickel. Because if you remember, there was a kind of similar story there. It rose by more than 33% in a single day, and it fell by more than 33% in a single day. So if you have a 3 times levered long or short fund, both were wiped out on the way up and then on the way down.
That's brilliant, isn't it? That's exactly what I want from a 3 times levered fund. It's like it's all going well, you're riding the rally, and then boom, just disappears into thin air. But this time that didn't happen with the silver funds. I think because they did something called a restrike during the day. It sort of split the day into 2 days, in effect.
Yeah, and that stopped the fund being wiped out, which is better for everyone, I think. You could say, well, that's kind of cooking the books. But no, I think it's actually a sensible thing to do. I mean, what benefit is it to people to lose the exposure completely?
But I think it's in the fund prospectuses where they do that. They have like a rule where if it moves more than 20% or something like that, then they'll restrike and start again.
But I think this points out something really useful for commodities, which is that, yes, they're volatile, and that's something you should be aware of. I think this was an education for many people. They didn't realize how volatile commodities have been in the past, whether it's energy, single commodities, or as we've seen with precious metals.
Does silver just behave like a high beta version of gold? Is it just a volatile version of gold?
I think to some extent that's true, and that's why the model works for both with different coefficients. They've got the same drivers, bar industrial demand for silver, which isn't there for gold. What I was worried about was that something would happen that happened in 1980, in the 1980s sell-off, and that's the spillover of volatility into other asset classes. Now, the reason why that happens is that if people have built up large levered positions in silver, say, and the price drops dramatically and they can't sell the silver fast enough, then they have to liquidate other assets. And the margin calls can be quite brutal if you've bought it on margin. So that means they sell the other liquid stuff, which makes volatility spill into those other asset classes, the liquid ones. So that could be equity, it could be treasuries. Now, in this case, it didn't affect equity markets. For example, the FTSE's pretty much close to its all-time high. The S&P didn't sell off much. There was a 2% fall, I think, intraday. But it did affect things like industrial metals, which was pretty shocking. Now, I've got a copper miners portfolio, so I didn't like that at all. And we saw other industrial metals like aluminium affected as well.
And other precious metals, like platinum.
Yeah, so for example, platinum fell by 23% on that huge crash day. Palladium fell 16%. And it's often the case that if you get one precious metal selling off, they all sell off together. They are highly correlated. So generally, an awful day for precious metals, a reasonably bad day for some other asset classes. But broadly, I think it was contained inside that complex, the precious metals complex.
But despite the worst day in 40 years, gold and silver are still up since the start of the year. They finished the month higher than they started it for January.
Yeah, so all that's happened is we've gone from crazy, crazy valuations to very high valuations.
I guess the question is, did we just see the sort of traditional blow off top and then the start of a massive crash taking us back to what your model might think is a fair value? Or is this just a blip amid a long-term bull market for precious metals? I think we'll come on to that question in the second half. And we'll also talk about why now? What was the trigger that caused this sudden sell-off?
Today's episode is sponsored by Trading 212, the platform bringing commission-free investing to everyone. Trading 212 Stocks and Shares ISA is the cheapest way to invest, with zero commission and one of the lowest FX fees I could find on the market. Looking to keep things simple, you can easily automate your investing with pies that allow you to rebalance your portfolio at the click of a button. Customers with Invest accounts can also benefit from the Trading 212 card, which has no FX fees, true interbank rates, and offers 1.5% cashback on all transactions up to £15 per month. Many Happy Returns listeners can claim free fractional shares worth up to £100. Just create and verify a Trading 212 Invest or Stocks ISA account, make a minimum deposit of £1, and use the promo code RAMIN, RAMIN, within 10 days of signing up, or use the link in the show notes. When investing, your capital is at risk and you may get back less than invested. Past performance doesn't guarantee future results. Pies and Autoinvest is an execution-only service, not investment advice or portfolio management. Automatic investing refers to executing scheduled deposits. You are responsible for all investment and rebalancing decisions. Free shares can be fractional. 212 cards are issued by Paynetics, which provide all payment services. Trading 212 provides customer support and user interface. Terms and fees apply.
Okay, so what caused this massive one-day move for gold and silver? Did it just come out of nowhere? Or was there a little trigger, a catalyst?
Well, I think it's pretty clear that it was the nomination of Kevin Warsh as the next Federal Reserve Chairman Now, that happened on January the 30th, and that was the day of the sell-off. So why would that affect these precious metals? Well, the thing is, the market sees him as a hawk. That means someone who's very concerned about inflation and wants to keep interest rates high.
Hang on.
Yeah.
We've spent the last, 6 months, a year saying the risk is Trump's going to nominate someone who cuts interest rates way more than they should. And that's going to risk high inflation. What's going on here? He's appointed someone who's famous for wanting to raise rates.
Yeah, and I think that's why markets pretty much misinterpreted that. But the reason why markets think that is that in 2010, he dissented against quantitative easing. Remember that quantitative easing is when the central bank buys up lots of treasuries. That makes their balance sheet expand massively. Whereas now, presumably, in the conversations he had with Trump interviewing for the job, that's unlikely to be the kind of signal that he was sending to Trump. And Trump seems very happy with the nomination. And of course, Trump wants interest rates at 1%. So that's got to call into question whether this guy is a hawk or actually a dove.
Well, there's some nuance here, though, isn't there? So he was a Fed governor once before. He served 5 years on the Federal Open Markets Committee during the financial crisis, as you said. And he was the one member of that committee at the time who didn't seem to go along with the consensus that this was a massive deflationary shock and the Fed needed to cut rates to zero and print loads of money, quantitative easing, like you say. And you can see the timeline through that period where every meeting he's basically saying, guys, we've got to keep an eye on inflation here. It turned out he was wrong, right? There was no inflation despite all the money printing at the time. And in fact, when it came to do QE2, the second round of quantitative easing in 2010, that's when Kevin Warsh had had enough and he basically quit the Fed, saying this is a big mistake. But he seems to have become more dovish since then, at least when it comes to interest rates. So I've seen various interviews and speeches by him where he's talked about AI as potentially being a deflationary force, and he expects greater productivity growth, which means that rates can be cut without fueling higher inflation. But one thing that hasn't changed is he still really seems to want to cut the size of the Fed's balance sheet. He's never liked QE, and the market expects him to go through perhaps an accelerated period of quantitative tightening. And Warsh says, somewhat controversially, that by shrinking the size of the Fed's balance sheet, that makes room to cut interest rates. Other economists say, well, that's not really how it works. But we'll see, right? We've never been through this process before for any extended period of time. But perhaps what the market's worried about is, if the Fed really starts draining liquidity from the market, that's not good for things like gold, which have relied on the so-called debasement trade a little bit, that narrative that the dollar's going to be devalued and the only real store of value is precious metals.
I think that's largely true, and I think it's interesting to hear what he actually said in one of these interviews. We're going to have to make a bet. Is the economy becoming much more productive? My simple version of this is everything technology touches gets cheaper. So let's say you're a central banker. If you're looking at the data, my view is that you're backward looking. You're going to be late. You're not going to realize the country is able to have non-inflationary growth faster. So you're going to have to make a bet. And the closest analogy I have in central banking is Alan Greenspan in 93 and 94, when the internet revolution was with us. He believed, based on anecdotes and rather esoteric data, that we weren't in a position where we needed to raise rates. As a result, we had a stronger economy, we had more stable prices. So really what he's saying is the Fed, which has been very much anchored on data and data-driven models and not relying on forecasting models under Powell, is going to be shifting lock, stock and barrel into a new era where it's based on opinion.
Vibes-based monetary policy.
Pretty much. And that's pretty worrying, I think. We are taking a big leap into the dark. Okay, the models aren't perfect, and the new era that we're entering is unprecedented. We've never had to shrink a $9 trillion balance sheet for the Fed before. So we don't know what the effects will be.
But if we take him at his word, and presumably what he's told Trump, he seems to want lower interest rates, i.e. push down the short end of the yield curve, but shrink the Fed's balance sheet, which all else being equal would presumably put upward pressure at the longer end of the curve.
Yeah, this is a classic curve steepening move, I'd say.
But even if you're setting monetary policy based largely on vibes and hopes, you can't do it in isolation. Economics is really weird, markets are weird, and I wouldn't be surprised if at some point the great irony happens and Kevin Warsh has to restart quantitative easing. I can see that happening over the course of his Fed chairmanship.
And this will happen, right? There's going to be some kind of turnaround if he's wrong. And that's a huge problem for the Fed, because one of the things that the Fed prizes most highly of all is its credibility. Does the market believe it can control inflation? And if it's continually having to make rapid turnarounds, that erodes that incredibly valuable commodity, trust.
But has the market got its view of Warsh right? Of all the people Trump was considering for Fed chair, he's the only one with a hawkish history. But I've seen some commentators say he's not so much an ideological hawk as one that flips between hawk and dove depending on who's in the White House. And that does somewhat seem to be true.
Yeah, you've got to say he's got the job. And if he's got the job, then presumably he said the right things to Trump, which suggests that he will be dovish. And he's come up with some kind of narrative internally. His vibes-based model is one in which rates will be lower and AI is going to be non-inflationary growth, at least in his view. And that's possibly true. I mean, we shouldn't prejudge the possibility that that is true.
I could certainly see that being true in the long term, but I would imagine there's a transition period where building all these data centers is sucking in so much capital and diverting resources away from other parts of the economy that it does have inflationary pressure. But we'll see. But anyway, the immediate reaction in markets was the dollar got a bit stronger, rose almost 1 percentage point, and precious metals, really dumped hard. That was clearly the spark. But the market structure, I think, poured fuel on the fire, didn't it? There was an accelerant here, which turned a bit of a sell-off into the biggest one-day crash of our lifetimes.
And to understand how this works, you have to understand a bit about the futures market, which is where a lot of these commodities are bought and sold. Now, if you buy a futures contract for silver or gold, you get a leverage position, which means you don't have to put all the money in up front. What you do have to put in is initial margin and then ongoing margin day to day, such that you don't build up a big positive or negative position with the exchange, because that would increase your counterparty risk for the exchange. So every day you kind of wipe your slate clean, you receive margin, you pay margin. So effectively you build up this buffer and that protects the exchange. Now, during periods of market volatility, the exchange has to protect itself, so it increases its margin requirements. And now that is what really made the sell-off, I think, quite a bit bigger. So, for example, one of the big exchanges for metals is the Chicago Mercantile Exchange, and their silver margins rose from 10% to around 15 to 16%.
So that's 50% higher margins. That's a lot more money people have to post against their contracts, isn't it?
Yeah, because the actual notional quantity of the silver that you're buying, for example, is very large because of the leverage. So that's a big change in margin requirement, understandably from the exchange. But as you say, I think that acted as an accelerant.
And you get the classic feedback loop, don't you? So prices dropped based on the Warsh news. Then these margin hikes meant that a lot of traders faced margin calls, which they were struggling to meet. So they were forced to liquidate their positions, which means selling the metal, which drives prices lower, which means more people face margin calls, which drives prices lower. And you get this loop and it goes down and down and down. And that's how we end up with a day of minus 30%.
Yeah, lots of sellers, no buyers. And then usually what happens is you have a bit of a bounce in the next few days. And that's precisely what we've seen, a big bounce in silver. I think it was 10% over the course of today so far. But then what can happen is you can have this extended period of sell-off. So this is just the initial sell-off, and then it can extend for some period of time. You can have false rallies, but I think this was probably the peak. I never want to commit to that, but I think it was the peak for now.
Interestingly, there's a historical parallel here, which is in the 1980s. silver bubble, which you mentioned earlier, where the Hunt brothers cornered the market. The exchange back then and the regulators brought in something called Silver Rule 7, I believe, where they allowed liquidation-only trading, i.e. people taking leverage could only sell their positions and not buy with further leverage, which was kind of the GameStop phenomenon, but, 50 years earlier.
But looking at that sell-off, it's an interesting one. There was a huge initial sell-off which happened very rapidly, and that was over the course of about a month. Then prices stabilized for a while. Then we got a kind of second rally. Then we got a secondary sell-off, and that lasted a couple of years. Then another big rally, and then another sell-off. So people have a memory of the huge rally, and they say, oh, look, it could happen again. They get excited again. And then ultimately it ends in despair.
They were right. They just had to wait 46 years, and then it happened again. You don't want to be early, do you? But I've got a question here, Roman. Precious metals are largely narrative-driven, aren't they? I think we both agree on that. But there are competing narratives at work here about what's actually happened here. And I want you to tell me which of these is most true. So I think the first narrative we've got is the kind of, I told you so, the bubble's going to pop at some point. And their position is, this crash was not only predictable, but necessary. This silver rally is basically a version of meme stock mania. We had speculators piling in, driving up the price. Those things never end well. The second position, I think, is more macro-based, and that is focused on Kevin Walsh. He's the hawk in the hen house. He's going to kill liquidity, and this Friday's crash wasn't just a correction, but it's like a new regime change. And if you are long precious metals, wow, you better get out of them quickly. And then I think the third position is that this crash was kind of artificial. It was market manipulation. It was driven by the regulators and the exchanges hiking margins just to push people into forced selling. They've screwed over the retail investors again. So what's true? Was this a kind of bubble that would inevitably pop? Or is this a regime change based on a whole new Fed? Or is this a rigged game against the little man?
I don't buy the rigged game argument. I think that's just not true. I think there are so many protections in place to stop people hurting themselves, but they still manage. Is it a regime change? I still think it's difficult to tell. Kevin Walsh, I think, changes with political breezes, and it's not clear what he's going to be like as new Fed chair.
Or if he'll even get his way as Fed chair. He's still got to sit on the committee and have people vote alongside him.
Yeah, you can't have an authoritarian Fed because it's just not wired that way. He has to convince the committee members. Of course, the chair has a lot of sway, but I think it's still the case that he would get pushback if he tried to do something that was maybe a little bit off-piste, a bit too off-piste.
I'd be surprised if his first meeting in the summer isn't a rate cut, though. Do you agree with that?
Well, markets are expecting it, so I think that's probably what will happen. And he has to please his political master. But I think the first point is definitely true, which is that it was a meme stock bubble, and the narrative changed. And if it is narrative driven, then ultimately that's going to hurt the asset class. And that was kind of inevitable, I think. It's easy to look back and say, yeah, I knew it would happen, but it was getting to absolutely crazy levels.
Yeah, I saw one thing reported, which was that, silver volumes are generally really low. It's a small market, which I think people don't appreciate. But on one of the days leading up to this crash, the biggest silver ETF in the US had trading volumes which matched that of SPY, which is the big S&P 500 tracker, which is like unprecedented. A silver fund matching the S&P 500 tracker for volume. And if you look online, there was a lot of chatter about silver in all the usual places where meme stocks get talked about.
Yeah, I saw in the FT there was a nice little comment which said that there was such big demand for silver that refineries were working around the clock to melt down customers' jewellery, dining sets, and even old dental fillings.
It's kind of crazy that silver went from a massive bull market to a technical bear market in one day. That doesn't happen very often. But surely the question now is what's going to happen next? You said that you're going to call the peak here in the silver price. So is that right? That's what you're going to say? It's the peak?
That's
Okay. It's a big call because I think the consensus among investment banks and analysts is that this rally has further to run with precious metals. They're not fully getting out of the geopolitics is dangerous kind of mindset. There's this debasement trade. Let's see if the Fed actually manages to shrink its balance sheet without blowing up the world. Though I think we are starting to see some voices saying, yeah, this is just the start. Silver's going back to $50. And those voices weren't there, I think, until this week.
If I was going to build a model which had other things in it, I think geopolitical uncertainty might be one of them. The reason why I didn't do that was because there isn't a reliable index which is freely available that would allow me to do that. But like you say, the source of the uncertainty, which is the Donald Trump presidency, is still there, and it's going to be there for another 3 years. And there was a nice point from Katie Martin, who's a journalist for the FT, who's been on this podcast. She said that the biggest threat to gold was the outbreak of sanity. If there was sanity in policy, that would be a huge threat to this precious metals run-up.
I think I might become a gold bug. That's not going to happen, is it? But let's think about what things could end this bull market for gold in particular. I think, like you say, the first point is sanity, both in political policy, but also if central banks get inflation back to target and keep it there, then that's going to weaken the argument for precious metals. Remember that inflation is not back to target in the UK or the US. I think the second point would be if the dollar starts strengthening, turns around, and it's not just a spike, it's a sustained strengthening. That doesn't look particularly likely, but you never know. Third point for me would be, geopolitics. If everything de-escalates, there's not a war in the Middle East, there's some sort of deal around nuclear arms with Iran, NATO holds together and we get a settlement in Ukraine, all of that stuff would be good for the world, but bad for gold, I would guess. And I guess the final point is the obvious one, based on your model, that if real interest rates pushed up massively, then that would be bad for gold. Am I sounding somewhat like a strategist now, Roman?
Oh, very good. Very good. And the real interest rate point is a great one. And I think that's driven pretty much by growth expectations. So if we did see a huge resurgence of US growth driven by AI or whatever else it would be, then that could be a problem for gold as well.
Growth is strong, though, right now, if you believe the numbers.
Yeah, and that could get even stronger if this AI investment starts to really pay off. So I think there's a lot hinging on that. Will the huge investment by companies like Microsoft, Facebook, Nvidia pay off in terms of what's going to happen in terms of US growth?
But to finish off with gold, I think we both agree that perhaps it has a place in a portfolio, right? A small allocation to gold can perhaps step up and save you in bad times, potentially lower the volatility of your overall portfolio, if it's just one element in the mix, because we know gold is very crashy. And that can help things like the safe withdrawal rate. I think neither of us had that view when we started this podcast, but we've kind of been persuaded of it now. And the fact that gold's rallied massively over the last few years helps, right? That's always helped change minds. But what I think, still believe is that speculating on precious metals, and any asset really, is a tricky one to pull off. You would have done well over the last few years, but is now the time to bet on the market in isolation? Who knows? But if you're doing the more conventional thing, and gold is a small part of your overall portfolio, has anything changed there? The one thing I was thinking is, this has been the most volatile month in history for precious metals. If you are running a kind of risk parity portfolio, higher volatility in one subsection of that portfolio presumably means there's an argument for dialing down the allocation a little bit. Is that right?
Yeah, if it's risk parity based, that's true. And I think that's probably what's happening with a lot of portfolios which are run by quants. Now, I've been running this global efficient core portfolio, which is using return stacking. The idea being that you can run a 60-40 portfolio, but because it's 1.5 times levered, that only takes up 2/3 of your capital in the portfolio, which means you've got 1/3 left to play with, which is split 50-50 between gold and broad commodities. Now, you might expect, given the huge sell-off in gold, that would have suffered a lot. But in fact, it's just hardly been a wobble at all. So over the last week, it's down 0.3%. Now, I was concerned. I had to double check that. I had to look at my portfolio over the course of this week quite often, but it actually has proven to be quite an effective allocation.
And to be clear, this portfolio you're talking about is like a mini portfolio in your fund portfolio, right? It's a small part of your overall portfolio.
That's right. I mean, I certainly wouldn't bet the farm on this. I was just experimenting with it to see if this could be my new core. And it certainly passed this test. I think there could be future sell-offs in which all four of those asset classes sell off together. It's just less likely.
I'm one of those people that really likes the logic and the back tests around all these kind of return stack portfolios, but I'm not brave enough to implement it as like my main portfolio. Just because I think leverage is great in a way. It's dangerous if you get it wrong, but it can be great, but it can also be taken away at the wrong time. What if that fund you're relying on gets taken away at the very worst time for you and you took the leverage on the way down, but then you can't get the rebound?
I think the biggest risk for me is that the fund gets closed down simply because there's not enough interest in it.
Yeah, that's what I mean. And there wouldn't be enough interest if it was in a big market crash, which is exactly when you would need to hold strong.
Yeah, that's possible. I think there could be outflows, but it does actually work pretty well. So I think, if anything, this is something that's going to become more popular in the future.
At the moment, I've been wondering, are we in that kind of everything bubble again, where lots of assets look expensive and precious metals have just been the first one to have a little bit of a pop?
Yep, looking at my portfolio, it's still in pretty good shape. We haven't seen big sell-offs in equity, for example. And the robustness of equity markets in the face of this big sell-off in precious metals does suggest that this could be the first one to wobble.
I guess Bitcoin was the actual first one to suffer. And now we've seen precious metals. What's next, Romin?
I wouldn't be surprised if US equity did have a bit of a correction. Now, what seems to be happening is fairly benign, which is that earnings are generally pushing up for the rest of the S&P 500 and just making the bubble erode slightly. Companies like Microsoft selling off after the earnings report, for example. So I don't think there's necessarily going to be a popping of that bubble for the Mag 7, say. I think it's gradually going to be a deflation and something else is going to come along to grab people's attention.
This morning I'm in a fairly bullish mood. I don't know why. Complacency, probably.
So we've seen the dangers of being drawn into one of these crashes in a single asset class in commodities. If you want to learn how to approach that better and become a better investor, just go to our website, pensioncraft.com/membership to learn more.
Okay, today's dumb question of the week. Why do we spend billions digging gold out of a hole just to put it back in a different hole? All right, we call it a vault, but it's still a hole. And if I want to put this really provocatively, Romin, if we just left the gold in the ground and somehow traded ownership of those unmined veins under the soil, wouldn't the whole economy work in exactly the same way, but with like less environmental damage and waste of effort and everything?
That's a really interesting idea. And I think that you can do that. You can trade mineral rights in that way. But the question is, if you gave me a certificate for an ounce of future gold, would I pay the same price for that as I would for actual gold in a vault? And I think I probably wouldn't.
Is that because of trust issues? Like, is the gold actually there? If I need it, will you actually be able to get it out of the ground, or will it be taken by the government?
Yeah, those would be my worries. There's a huge difference between having the physical metal sitting in a vault and the promise of having physical metal sitting in a vault. And as you say, a large part of that is the issuer. Who is it that's saying, I will deliver this in the future? And if I don't trust that person, then yeah, the value of that contract wouldn't be particularly large.
I guess from a practical point of view, there's a verification problem to begin with. Like, scientifically, how can you like prove those veins exist, the purity, how extractable they are, all of that stuff? The good thing about a gold bar is it's standardized. Sort of. There are different gold bars depending on which vault it's in. I actually went to the Bank of England yesterday and lifted up a gold bar. Surprisingly heavy.
Oh, I've lifted that gold bar. Yeah, that's brilliant. I love that.
That's what inspired this question. I thought, why is this gold bar just sitting here doing nothing? There's a little camera above it as well, just looking right at your face, just in case you just try to walk out of the Bank of England with a gold bar.
I did try and pull it, but it didn't come out. It's in that Perspex box.
It is. But to go back to this genuinely dumb question, even if you solved that scientific problem, right, with some sort of radar mapping of the soil and you were like 100% sure there's the gold, sat there nicely, half a mile down. Let's not dig it out. Let's just trade it contractually. The trust point is still true, right? People like gold because there's, in theory, no counterparty risk. Your gold is no one else's liability. That's not really true, is it, of a patch of land?
Yeah, if you speak to a gold bug, there's a psychology that goes with the asset class. And that psychology is very firmly ingrained. It has been for centuries. And it's ultimately about trust. Do you trust the government not to print lots of money? Do you trust your counterparties, as you say, in these financial contracts to make good on a deal? Well, you don't need any of that if you've got the physical metal sitting in your hand. And historically, when push came to shove and society essentially collapsed, you could still use gold as a means of barter.
Yeah, I mean, people say there's no counterparty risk with gold. I don't quite believe that. And I think neither does Germany now. They're talking about pulling their gold out of US vaults. So there must be a theoretical counterparty risk there. The shelf has your name on it, but can you get your hands on it? I think there's another point here, though, which, yeah, on the face of it, digging a shiny metal out of the ground just to put it back underground is completely pointless, right? If aliens landed on Earth, they'd be like, guys, what are you doing? What are you doing? But we're weird humans with weird psychology. And I kind of think gold's status as money for thousands of years, in a way, relies on the fact that we have this ritual. It's bound up with the physicality and the fact it's expensive to extract and dangerous. And it's almost like you need that, and I'm going to borrow a term from Bitcoiners here, proof of work. Like there's a proof of work that goes into it. If the gold was just sitting on the side of the road and we just had to scoop it up, it wouldn't be the same kind of thing.
Yeah, that's right. It's scarcity, proof of work, however you want to describe it. It is difficult to obtain, and that makes it special. And it doesn't tarnish. I think that's another weirdly attractive property as a metal. And it's beautiful. If you look at the museum at the Bank of England, people often crowd around the gold exhibits because that's the most interesting thing there. Yeah, they've got bits which they've dug up, like bits of Samian ware, which was from an excavation of the premises. They've got some lovely mosaic. Soames did an amazing job of the architecture, but it's the gold that really grabs people's attention. And my biggest concern always is that we're going to have a huge flood of supply, whether that's from fusion reactors, which can turn other metals into gold. We've discussed that in the past. Whether it's some gold asteroid sitting out there in the asteroid belt, which is going to massively increase supply. That could really affect our value that we attach to gold. If the streets were literally paved with gold, then it wouldn't be so special.
Yeah, but I don't want the asteroid gold. I want gold out of mines on Earth, the real gold, Roman. You laugh. But that's exactly what people say about diamonds.
Which is another market that's just crashed.
Oh yeah, true. Thank you for joining us for many happy returns. Keep sending us your questions, no matter how dumb, at mhr@pensioncraft.com.
And do remember to check out pensioncraft.com for all the information about our membership, courses, and investment coaching options.
Many Happy Returns is a PensionCraft production, co-hosted and executive produced by Roman Nakiza and Michael Pugh. This podcast is for informational and entertainment purposes and is not financial advice. We do not provide recommendations or endorse any decision to buy, sell, or hold any security. We cannot be held responsible for any actions listeners may take, and investors are encouraged to seek independent financial advice.